Hello and welcome to another session of the My Solo 401k Financial Weekly YouTube Live webinar. We're just going to wait for the viewers to join before we get started. Okay, great. I see that we have the viewers appear to be logging in. So again, thank you for taking the time to participate. This is being recorded on YouTube. You can come back later to watch the recording. Today's topic is a very hot topic, which is going over the recent proposal in Congress, which would have a few significant impacts to self-directed retirement accounts. So we've had a few sessions on this topic. We're going to continue to spend time on it. For example, on our My Solo 401k Financial My Community website, we have a forum on there where we're tracking a number of different issues. We've been having weekly webinars to go over this topic, and you can easily join by going to the link. Here's the link to the website, which is mysolo401k.net/mycommunity. So that's a great place to continue the conversation after today. So today's topic is going to be focusing on the differences in the proposal and the impact to IRA accounts versus solo 401k accounts. So we've got a few good slides to discuss. I would emphasize that we're also going to talk about some of the things that you might want to consider doing now. There's really two things. Number one would be, if you object to what's being proposed, would be to reach out to your congressperson. The other thing would be, if you're concerned that the proposed ban on the ability to make backdoor Roth solo 401k contributions is going to go into effect starting in 2022, then to go ahead and make those contributions for 2021. So just to highlight that right at the outset, but we're going to go through that in a little bit more detail. But otherwise, let's get started. And I would mention, as we're going through these slides, if you do have questions, please chat them over through the YouTube chat feature and function, and I'll field the questions as we go through them. So this slide here, we're going to dive in and talk about the impacts of the proposal if it's enacted to IRA accounts. On the next slide, we're going to talk about the impact to solo 401k accounts. So we'll start out with, what is the impact to IRA accounts? So number one, the impact is going to ban backdoor IRA conversions. And that's going to start, if it goes into effect, in 2022. So a backdoor Roth IRA conversion is where someone is making a non-deductible IRA contribution because their adjusted gross income is too high, so they're not eligible, so they're phased out. They're not able to make a Roth IRA contribution. So the way that they're still getting money into their Roth IRA is through this so-called backdoor Roth IRA strategy, where the individual makes a non-deductible contribution to their IRA and then converts it over to the Roth IRA. So starting in 2022, if the proposal is enacted, those would no longer be allowed. The next proposal that we want to touch on is going to impact high-income taxpayers, which is going to be defined as someone that's earning, a single person that's earning more than $400,000, or if you're married filing jointly, if your adjusted gross income is more than $450,000. So if you are in that high-income taxpayer bracket and you have a large retirement account balance, where that's defined as more than $10 million across all the different accounts that you might have, whether it's IRAs or former employer plans, etc. In that situation, you're no longer going to be able to make either IRA or Roth IRA contributions if the proposal goes into effect. Next, in terms of the IRA impacts, is there's a new proposed required minimum distribution. So this would again apply to a high-income taxpayer, meaning you earn more than $400,000 or $450,000, whether you're filing as a single person or whether you're filing married, filing jointly, and you have a large retirement account balance, which again is over $10 million across all the different accounts that you have. So if you're in that category, the excess over $10 million in your retirement account balances is going to have to be distributed. So there's going to be a new required minimum distribution. Normally, we think about required minimum distributions as applying once you reach a certain age, 72. This required minimum distribution has nothing to do with your age. So you could be below 72 years of age, but if you're in that high income taxpayer bracket and you've got that large retirement account balance, under this proposal, you'll now have to withdraw a required minimum distribution. No, so this, in simple terms, it's going to be 50% of the excess. It can get a little bit more complicated depending on, for example, if it's above 20 million, or if you already are taking an RMD, but that's the simple explanation. Okay, great. And as we go through these, if you have questions, I'm happy to field the questions. So the next proposal that we want to talk about is that the proposal would ban the ability to make pre-tax IRA to Roth IRA conversions, but it wouldn't go into effect, number one, for 10 years. So it wouldn't start until 2032. And it's limited to those high income taxpayers. So again, above $400,000 or $450,000. So if you're a high income taxpayer, 10 years from now, you're not going to be able to convert money from your pre-tax IRA account over to your Roth IRA account if this goes into effect. And then lastly, in terms of the IRA impacts, the proposal would ban a whole category of investments, specifically what are commonly referred to as accredited investments that are available to accredited investors. So an accredited investor, in simple terms, is someone that has, usually they have a certain level of income or they have a certain net worth. So the idea being that this is a more sophisticated investor. So the investment provider, right, the entity that's offering the investment, doesn't need to worry about giving as much disclosures that you would if you were offering investment to the general public. So there's a large number of IRA account holders out there that have invested in those types of investments. They're very popular tools, for example, for startup businesses, for real estate investments, so for real estate projects. So going forward, if this proposal is enacted, those types of investments would no longer be allowed in your IRA starting in 2022. So if you already have an IRA that has one of these banned investments, you'll have 2 years to correct that. So you're either going to correct that by selling the investment, so now you have cash in your IRA, or taking a distribution, but that means you got to pay the taxes and maybe penalties on that distribution, or you could roll it over to a solo 401k if you're eligible. So you would be eligible to roll that investment in kind. So you're not selling it, right? Not taking it as a taxable distribution, but just transferring it over to a different retirement account. So you could transfer it over to a solo 401k, like the type of plan that we offer, if you're, number one, eligible to set up a solo 401k. So that means that you're self-employed, there's no full-time W-2 employees working for any business owned by you or a spouse, if any. And if that particular banned investment is in a traditional IRA, because if it's in a Roth IRA, you're not eligible to roll over assets from a Roth IRA to any type of 401k, including even a Roth solo 401k. So that could be an option for at least a certain subset of IRA account holders that have one of these banned investments and needs to correct that within that 2-year transition period that's being proposed in the legislation. So that takes us to the provisions that we wanted to highlight that are going to impact IRA accounts. Before we go on to 401ks and the impacts of the proposal to solo 401ks, we'll also highlight that the proposal would extend the statute of limitations. So it would extend the statute of limitations from 3 years to 6 years after a return containing an error was filed. This is going to, of course, give the regulators, the IRS, more time to pursue perceived IRA non-compliance. And so that's another noteworthy provision that's in the proposal. It would extend the statute of limitations for IRA accounts. Okay, great. So now let's turn to the next slide, which is going to go through the provisions that would impact solo 401ks. So let's first start out with the proposal that would eliminate the ability to make mega backdoor Roth solo 401k contributions. When would this go into effect? Pretty much immediately. So January 1st, 2022. So if you want to make a mega backdoor Roth solo 401k contribution for 2021 and you're worried about this proposal being enacted, you would want to go ahead and make that before the end of the year. So technically what's being banned is the ability to make what are referred to as after-tax contributions in a qualified plan. And that's the first step in making a backdoor Roth, a mega backdoor Roth solo 401k contribution. Because those voluntary after-tax limits, those contribution limits are higher than the Roth solo 401k contribution limits. That's how some people are able to contribute as much as $58,000 or even $64,500 into their Roth solo 401k for 2021. So under the proposal, again, it would be banned starting next year. So if you want to do it for 2021, you're going to have to go ahead and do it before the end of the year, meaning make the voluntary after-tax contribution into the separate voluntary after-tax sub-account and then converting the money over either to your Roth solo 401k sub-account or a Roth IRA. So what else is going to be impacted from a solo 401k perspective? Well, the new required minimum distribution. We talked about that in the previous slide. So again, that applies to those high income taxpayers with large retirement account balances. So in looking at what's in your large retirement account balance, it's going to include your solo 401k funds. So while under the proposal, you don't necessarily have to take that 50% of the excess, so that new required minimum distribution, you won't necessarily have to take that out of your solo 401k. It is going to impact the solo 401k and to the extent that in determining whether you've crossed that $10 million threshold, you got to include the value of your solo 401k. So that means your cash, your investments, etc. Next provision that's going to impact solo 401ks is the ban on pre-tax to Roth conversions. So previously we talked about that in the context of an IRA. So that same ban is going to impact solo 401ks. So for those high income taxpayers, starting in 2032, they're no longer going to be able to convert money from their pre-tax sub-account of their solo 401k to their Roth sub-account. So that would be banned starting in 2032. So we got some lead time, with that one, of course, but it's definitely noteworthy as it would be an impact to solo 401k plans. Lastly, in terms of the provisions that would impact solo 401k plans would be a new reporting requirement. So starting next year, so after 2021, there would be new required reporting to the IRS of any participants who have balances of at least 2.5 million. So you've already got your 5500 EZ filing requirement in that situation, but now in addition to that, there would be new reporting for any participants if the value is above 2.5 million, presumably to help the regulators determine whether or not you've crossed that $10 million threshold. So what's not impacted by these proposals? So it's definitely noteworthy that the ban on IRA contributions for high income taxpayers, right? That's under our IRA slide. It's that second column here. For high income taxpayers, prohibit IRA and Roth IRA contributions if aggregate amount exceeds $10 million. So if you got a large retirement account balance and you're in that high income taxpayer group, you no longer would be able to make IRA contributions. But what remains? Well, you could still make pre-tax and Roth solo 401k contributions, of course, based off of your self-employment income, subject to the limits, et cetera, et cetera. But those are still on the table. Those are not banned. What's also still on the table would be contributions to SEPs, to simple IRAs. So really all the employer associated plans would remain. But what would be eliminated, again, for the high income taxpayers with a large retirement account balances, would be the ability to make IRA contributions. So there'd still be some tools in the toolbox, but obviously this is an important tool would be eliminated. So let's give a couple examples just to illustrate that. So Julie has a solo 401k balance of $9,995,000 on December 31st, 2021. If she wants to make an IRA contribution in 2022, she can only contribute $5,000 to her IRA, because otherwise that would take her up above the limit. But she could still contribute to her solo 401k plan. So go figure. But at least they haven't touched that, which is good news. Jack has, next example, Jack has $12 million in his solo 401k as of December 31st, 2021. He would not be able to make an IRA contribution in 2022, but could contribute to his solo 401k. So Jack is above the threshold, so he can't make any more IRA contributions, but he could still make a solo 401k contribution. So thank goodness we still got that tool, but it's still an important tool that's being eliminated. And so there's still time to raise your voice and to let your congressperson know. And we're going to talk about how you can contact your congressperson here at the end. Okay, next slide we want to highlight is that required minimum $10 million threshold is of course going to include amounts in your solo 401k. And so again, if you're above that high income taxpayer group, you're still going to be able to make those SEP, solo, and simple IRA contributions. So the account balances used to determine the $10 million threshold is going to include IRAs, defined contribution plans, which is a solo 401k, other qualified plans, 403B, 457. And so that 50% RMD, that new required minimum distribution, it applies regardless of your age. So even if you're younger than 72, just like with current RMDs, you would not be able to transfer to another retirement account. The 10% early distribution penalty is not going to apply. But what's different about these new RMDs, under the proposal, is that they would be subject to a 35% mandatory federal tax withholding. So that's certainly noteworthy. So what can we do, right? We talked about one practical thing is that going ahead and making your backdoor Roth IRA and or solo 401k contribution for 2021 before the end of the year, if you believe this is going to be enacted. But more importantly, I would say, is to call Congress. So the number here is 202-225-3121. You'll then just simply need to give the operator, the person who answers the phone, your zip code. They can connect you with your congressperson. They can connect you with your senators and let them know, you're not a billionaire, right? A lot of these proposals are really stemming from the investigative report that revealed that Peter Thiel and other ultra wealthy people had these very high Roth IRA balances. For example, Peter Thiel's Roth IRA balances reported to be over $5 billion. And so there was a strong political reaction to that. The So let them know, you're not a billionaire. You're an everyday taxpayer, an everyday small business owner. These are important, retirement tools to save for your family's retirement. And you oppose the ban on backdoor Roth IRA and solo 401k contributions. You oppose the ban on limiting your investment options. According to there's so much up in the air politically. It's definitely got a long way to go legislatively. According to the most recent legislative reports, it seems that it's definitely at a minimum weeks away from proceeding legislatively. And again, it's still got a ways to go. At this point, it's gotten out of a committee in the House. It would still need to go through another committee called the Rules Committee, where it could be amended or maybe even eliminated. If it got past that committee, it would go to a full House vote. Then it would have to be approved by the Senate before it gets sent to the president to be signed into law. So there's still a ways to go, which means we still have time to let our Congress people know, how this would impact everyday taxpayers and small business owners. As I mentioned at the outset, please follow the conversation at our community. We've got a dedicated page on the website where we've got a number of topics and conversations going. Like I said, we've been hosting multiple webinars, and so we're going to continue to do that to give updates to the community and answer a lot of the questions and share the knowledge that we're just hearing from our clients and other community members. I really appreciate you taking the time to join today and participate in the conversation. If you do have any questions, we do have more time. Feel free to chat it over and we can go through the questions. Okay, I don't see that there's any questions. So again, thank you so much for the participation, and we'll take it from there. Thank you so much.